Our hour to talk taxes and anything related to taxes and bills you get from taxes and wondering about Obamacare and the upcoming changes in the tax law and anything that has to do with tax law. Give us a jingle, 8030930, 8030930, star 930 on a cell phone, because we want to help you. Because I work from EG Tax, and I got Tiffany Fabian.
Hey there,
How
Esther.
are you, Tiffany?
Very
and Christopher Fabian.
Hello, Esther.
Hey,
cold.
Chris.
I'm cold.
I know, I'm telling you. My girlfriend went to Grand Rapids this weekend, and she says, "Oh my God, it's like snowing and snowing." And I said, "You should come to Buffalo because it doesn't snow here."
No.
Right?
No.
But it is chilly. It is chilly. But
Yeah.
I think it is beginning to look a lot like Christmas now. And tax season, right? And we got
right.
several things to help you. You know, I did a radio show the other day for WDCX, and we had an open mic session about Obamacare, and basically people said, well, why would you care about Obamacare? I care because your tax returns the vehicle to report whether you have health insurance, and we have to do these credits if you're paying for health insurance and you didn't get a subsidy, or we're going to have to charge you if you got too much subsidy, and if you're going to be penalized, we have 22 penalties to get you out of penalty, and that's why we're talking about it, because come January it becomes real serious because the penalties that happen.
We're the check and balance for the IRS.
Right. And so as a result of that, we have our own Obamacare specialist, and we help people. I'm going to tell you, if you have no health insurance, we charge Zippo to do this. You need to call us because we want to help you so that you can get health insurance. It was interesting. Just before I came here, I was in the dress barn with my mother, and there's Canadians in there. And I heard them talking to the lady about how wonderful their health insurance is in Canada, and too bad you guys don't have health insurance here. And I really wanted to just sit them down and talk to them, because we do have whatever this is called
The law
here,
of the land.
and because it's so confusing, we want to help you. So I'm Esther Galicia, the tax lady. 8030930, 8030930, star 930 on a cell phone. All right, Chris, and we got what coming up to help people?
Well, concerned to help. Yep, we have our seminar coming up on December 3rd at the Holiday Inn, right off the 290 on Niagara Falls Boulevard, from 6 p.m. till whenever. We're going to have talk self-employment. We're going to have Obamacare. We're going to have Bill Barber for insurance to talk to you about whatever your insurance needs for businesses, life insurance, car insurance.
And Dennis Kitchen's going to be there. He'll talk about estates and trusts and wills and estate planning. And it's a free seminar, and it's our way to plug into the community to help you. And so if you want to register, can they register online?
They can register online at egtax.com. We got a link there for a registration. Or give us a call at the office at 632-7886, 632-7886. And we will happy to take your information right over the phone.
That's cool.
Yeah.
All right. And the other thing is, if you're a professional tax preparer,
Right.
and you're worrying about you getting your certification, EG Tax is also a qualified IRS approved educator.
Right.
And
We
you can,
offer
go
the
on.
federal tax preparer course, and it's a refresher course, and you get continuing education. And the best part is afterwards, you take the 100-question test, and if you pass the test, you are then a certified federal tax preparer, which is really exciting. And so then you're going to go on the registry on the IRS site, and they're going to list who are licensed to
prepare taxes, right?
Accurate tax returns,
Right.
exactly.
And this is a voluntary program right
Yep,
now, because
it
there's
is.
but the state of New York has an involuntary program starting next year, and you have to, if you're preparing taxes in New York State, get certified. So that's something that EG Tax will be involved in as well. So,
That's right.
So if you're a professional tax preparer, if you're somebody without insurance, if you're wondering about insurance, if you have insurance, it's costing you an arm and a leg, you're wondering if Obamacare would be better for you or the exchange, if you're wondering about your taxes, you want to do last-minute tax planning, EG Tax is your resource. And you can click on egtax.com, and we'll be very happy to help you. In the meantime, if you would like to join us here, we'd love to hear what you have to say. 8030930, 8030930, star 930 on a cell phone. And we're going to go to Doug in Lewiston. Hey, Doug, how can we help you?
I have a question about my mother, who is elderly, who stays with my sister who cares for her. And my mother just recently qualified for a veteran's disability pension.
Okay.
To get so much per month, which she was going to be passing on to my sister because of the expenses involved with taking care of her.
Okay.
And I was just wondering what the tax implications are for both of them, I guess. I would think that my mother would be subject to tax on that.
No, as a matter of fact, if it's a VA pension, Doug, if it's a Veterans Administration pension, that's going to be tax-free to your mom.
Oh, it is. Okay.
Okay. Now, your sister, if she's performing a service and your mother is paying her for that service, if that's what your sister's doing, is she's actually charging your mom for the home care, then that's a horse of a different color, right, Chris?
That would be self-employment, and so that would be income tax and self-employment tax.
Employee.
But if she is just trying to help out with the bills, that would be a gift. So that would not be taxable.
So it would seem to me that if your sister is not really charging your mom for performing services, your mother is just reimbursing your sister for room and board and reimbursing her for expenses that she's incurring, then your sister would not be taxed on that income.
Okay, well that's answers the question pretty well, because that would be the concern. Because she's not really charging her for services.
Right.
She lives there, and she's
just helping with the expenses.
Care of all the expenses, right? And my sister she's on Social Security at this point,
right?
So she's limited as to how much income she could make. So she was kind of concerned about that.
So your sister's under the age of 65.
She is.
Okay, so your sister would be limited to $15,430 in wages that she could get. And again, if she were charging your mom, then that would be self-employment income, and your sister would have to pay self-employment taxes on that as well. So if your sister has questions, she can call us at 632-7886 or just email us through our website at egtax.com, and we'll be able to help her. But if really all that mom is doing is offsetting some of the expenses that your sister's incurring, then it's a reimbursement. It's not going to be taxable.
Okay. Well, thank you. Appreciate it.
You're very welcome. Thank you, Doug. And, the issues of aging are so important. I just had several people come in yesterday about elderly parents and what to do and life estates and things of that nature. And that's part of what's going to be answered at our seminar that we're having December the 4th. So if you're interested in that, you can call EG Tax at 632-7886 or go on our website at egtax.com and register for our seminar. We want to talk to you after the break, 803-0930, 803-0930, star 930 on a cell phone, and we'll see you on the other side. Do you remember them days, Chris?
No, getting too old.
Okay, all right. Who is it?
Foo Fighters.
Foo Fighters.
Okay.
What could Foo be? We can't say what Foo could be.
But they fight it, so it's okay.
I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone. All right, we're going to talk, I just want you to know, everybody, the end is near. December 31st is 46 days away. Then the new tax year happens again.
The Grim Reaper?
So, here's some suggestions. If you haven't contributed to your pension plan, I think we say this a lot, especially if there's an employee match, you are throwing away money.
Yep.
So if, let's say that there's, your company is a company that'll do 3% of your gross wage employee match, and you put in $1,000 in your pension, and your wages are $40,000. 3% is $1,200, so it's going to be $1,000 or $1,200, whichever is less, and so they're going to match it $1,000. So you're going to get a 50% return, tax-free, right?
Yep.
It's pretty odd.
So, and maybe I don't even know what makes people not do stuff.
Yeah.
But maybe if you need us to give you energy
Or-
juice or talk to you about it.
Sometimes when you put pen to paper, there was somebody who, Social Security, I wrote down all the numbers and you did the math and you show them in black and white. It makes
that's
a
one of the
difference.
things I love to do when I'm doing a tax return. I say, now, here's your tax return. Now, if you do this, see the refund?
Right.
If you do this, see the refund. And go,
Just
Well,
makes it come
I
alive.
know with teaching our class the other night, we're talking about contributing to an IRA and the retirement savings credit. And I said, you take a child, not a child, but a kid who's 25 years old, they put $1,000 into an IRA. The federal government, depending on their wages, if we say about $18,000,
gives them $500.
yeah, they
Extra
end
back.
up. It ends up costing them $330.
Now think about this. If on Tuesday you get your taxes done and you put $1,000 in the bank on Wednesday into your IRA, all right?
Yep.
Then you legally get a $500 credit.
Yep.
And on Friday you go
You
and
take
it
it
out.
out.
And you're in the 10% tax bracket. It costs you $200.
Right.
They paid you $500
Yep.
on Tuesday, and it costs you $200 on Friday.
That's-
You made $300.
That's what I was
break
teaching
that
them.
down to clients. They're like, "Wow, really? You can do that?"
I'm telling you, and that's part of what tax planning is all about. Anyway, we have Joe who's been waiting. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 and a cell phone, and we got Joe from West Seneca. Hey, Joe,
Yes.
how are you?
Thank you. Good. Thanks for the program. Hey, when you give money to people, that you have to have a record of that, and there's restrictions, right?
Well, yes, there really are restrictions, but you'd be surprised how there's really not anything like what people think.
How about say you want to give, say, a substantial amount to a tax-free, tax-exempt.
All right, so you
charity.
want to give a gift to a charity.
Yeah.
There's no gift tax exclusion on a gift to a charity. You don't have to do a gift tax return on that. There's no limitation except that the deductibility, if it's cash that you're giving, is limited to 50% of your adjusted gross income without carrying it forward. Okay?
Yeah.
So they won't let you take more than 50% of your adjusted gross income as an itemized deduction, but you just carry it forward. You don't go do a gift tax for that. You do a gift tax return if you give an individual more than $14,000 a year.
Uh-huh.
But here's the rub. See, this is what people don't know, is that if you have an estate worth less than $5.5 million, there's going to be no gift taxes anyway. So let's say that you're somebody that has $100,000, and let's say that you have decided you want to liquidate your estate, and at Christmas time you're going to give your family $25,000 apiece. Well, the gift tax exclusion is $14,000 a person, but you, in essence, have given away all your money. You do a gift tax return, and you're going to pay no gift taxes anyway.
Oh.
So it's used to adjust your unified exclusion upon your death, but if that's over, if you have an estate of less than $5.5 million federal, it's not going to cost you anything anyway.
Thank you.
Okay?
Yeah.
Thanks, Joe.
Bye.
Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 cell phone. Yeah, Chris.
I was going to say, if he was talking about record keeping and who you gave it to, he sounded older. If he was concerned about Medicare with nursing homes, yeah, you want to keep track
Okay.
of anybody you give over $3,000 because
And
they're going to question
and that is true. I mean, from a gift tax standpoint, it's really not a problem. However, and that's what's so complicated about tax law, is that tax law kind of flows over into Medicare law sometimes. And so if you're somebody that's looking at liquidating your estate because you are older and you think you may go into a nursing home, well, that's a horse of a different color, right?
5-year look back. Right.
Right, and so that's what you have to be careful of. The ladies that I talked to yesterday were concerned about their family, and I said, do a life estate. Mom and Dad get to retain ownership of the house. It's still taxed the way it was when Mom and Dad had ownership, and at least there's some protection for Mom, as they were thinking about maybe selling the house first. At least Mom can stay in the house second to die, because nobody's going to take the house in that situation. So gifting, you're not going to pay a gift tax, really. You might have to do a gift tax return, but you won't pay a gift tax. But you have to be concerned if you're doing that in anticipation of going to a nursing home, because there is a 5-year look back.
Right.
Right?
Yep.
All right, let's go. Let's see. Another thing, end is near. Get Christmas money from the IRS and New York State. Don't take it out of your pension. Change your withholding. So all you need to do is change your W-4 at New York on the federal, or in New York State. What is it? NY 2105.
Yep. 2105-4 or something.
Right. And so all you do by doing that is you reduce the amount of money that's going to the federal government, so more of it's coming to you, and use that money for Christmas times, holiday gifts, instead of going and doing credit cards.
Because how many people already have refunds coming, and all they're doing is adding to their refunds for these last few paychecks. Take that money now, use it for your Christmas cards. Don't put it on your charge card saying, I'm going to use my refund to pay them off, because then you're paying 22% interest, 28% interest.
I had the other day, somebody called me. She's a single taxpayer, and she makes quite a bit of money, and she's been doing it zero she's been doing 10 or something. And I said, make sure that you adjust that. She was doing a lot.
All right, so the more allowances you claim, the less they take out.
Yep.
So if you're claiming 0, they're taking the most that they can. If you're claiming 10, then they're taking out very little. And so what Tiffany's saying is that person did the opposite of what we're talking about. It's not modifying to get more back. She never paid anything in. And that's a big problem.
Right.
Big
come
problem.
Tax time.
Okay, let's go back to the phones, and we're going to talk to Ryan in Depew. Hey, Ryan, how are you?
Hi, how are you?
Good.
When you own a business, a corporation, are there ways that you can carry profit from one year to the next into the corporation to pay bills when you anticipate a slow year? Or do you have to take everything out in payroll?
It all really depends on whether you're a C or an S Corp.
Mm-hmm.
Are you a C Corp or an S Corp?
C Corp.
All right. So how many shareholders are there? 2. Why are you guys a C Corp?
That's a good question.
Okay, so...
Change.
Election.
How would an S work? Would that...
Well, an S Corp, many times accountants will put people into a C Corp because they have them on a fiscal year. And unless there's a really good reason why you're on a fiscal year, I don't know why you'd be a C Corp necessarily. So what I would do is I'd suggest you give us a jingle or go talk to your accountant about moving to an S Corp so that the gains float through to your personal return, and then you've already paid the taxes on it, but you're not going to have to do double taxes. See, the trouble with a C Corp is you're going to pay, the corporation's paying taxes on the net profit, and when the corporation distributes and declares a dividend, then you, Ryan, pay another tax on the dividend.
Mm-hmm.
But if it's an S Corp, you pay one tax, and that would be what flows through to your personal return. So many people are C Corps, and they should be S Corps, and it's a very simple election to change you from a C to an S. Okay, so
right,
why don't you call us on Monday, and we'll be very happy to help you, okay?
Thank you.
Thank you, Ryan. Bye-bye. Lots of people are C Corps, and they should not be.
I not until I actually see it do I like, I do several tax returns for people who are C Corps, and they get these large dividends, and then they're like crying around tax time. And so then it comes alive.
So
to
if
me.
you had $100,000 net profit on your business, the business is going to pay $100,000. And so let's assume that would be your $100,000 that would be dividends. So that you distribute the dividends and you pay taxes again. So that's why C Corps are doubly taxed. But a subchapter S is taxed as an individual. So that $100,000 goes to your personal return one time. That's it. So if you're a C Corp, talk to your accountant about it, and if you want, call EG Tax. We'd be very, very happy to help you too. Okay, we're on almost at the news. I'm Esther Gullius, the tax lady. 8030930, 8030930, star 930 on a cell phone. See you on the other side. I have no idea. Tyler, all right. Who is it?
It's the Black Keys.
The Black Keys. Well, at least it
Is
isn't
that who the Foo Fighters are fighting?
the
Yes.
Black Keys. That's right.
Epic
I'm Esther
battle.
Gullius, the tax lady. 8030930, 8030930. We have Dave from Tonawanda. Hey, Dave, how can we help you?
Hi,
Hi, how you doing?
Good.
I got a little complicated question.
Yeah.
My wife passed away. Now,
Ah.
we had our own separate IRAs, and they weren't together. So she did not start minimum distributions because she wasn't quite 70 and a half when she
Right.
died.
Right.
So I suggested to my children the stock that their mother had, they sold it and paid no gain on it because they inherited the stock at the price.
Right.
And I told them to take the money out of the IRA fund and supplement it by taking money out of the stock fund and maximizing their IRA and 401k.
Okay.
And that way there, by taking that money from the stock and putting it in to their 401k, it's like taking out of their paycheck, actually, and putting the maximum in and supplementing it with income from the IRA, they're going to defer payments on
Right.
it.
Right. Okay, but here's a couple of things. And I'm sorry to hear about the loss of your wife. Now, in order for your kids to have gotten the IRAs, it means that they were the beneficiaries on mom's IRA. Is that correct?
was
The kids were the IRAs?
That is correct. They are the beneficiaries.
All right, so the kids got the IRA money. Now, when they got the IRA money, they could either take it all in the year they received it, and then it would be taxable, or they could take it in 5 years, or they could annuitize it based upon their life expectancy.
They annuitized it.
All right, so they annuitized it. So they're taking a little bit of a year out based upon their life, right?
Right.
All right. So if they're taking out $300 a year and they're entitled to put $5,500, for instance, into an IRA, then that would mean that they have to come up with $5,200 on their own.
Well, they are. They're making enough money where they'll be able to contribute the maximum.
Well, that's great. So that you are a very wise dad for telling them, because I'm going to tell you something. If you don't die, you're going to get old. If you get old and you want to retire, you're going to wish to heck you got some money set aside. You know, I mean, it's only logical that would be what parents would tell people, but it's great that you're setting that example because it really is a wise thing.
And don't forget, though, if they have 401k plans at work, they're not. Was he talking about the adjustment to income?
Yeah, you do have to.
You're not entitled to the adjustment to income.
You do have to factor in the fact that if they have pension plans at work, they may not be able to deduct the money they're putting into the IRA. They might have to move into a Roth. So it all depends on whether they're under a qualified pension plan and what their income
is. They have no pension plan. They just have IRAs. So
okay, well that's great. Well, that is great.
The only thing they're actually going to do is defer payment on that 401k money until they get old and retire.
Sure.
And by then, who knows what's going to happen?
Ain't that the truth?
They might,
Maybe there won't be a United States.
Well,
I mean,
the way it looks,
I know.
the United States of Mexico.
I know, ain't that the truth?
And then, Dave, I always say this to everybody, but if your wife was over the age of 59 and a half, depending on the proportion of how much each kid got, they can deduct a portion of that on New York State, and it won't be taxable.
Right.
So
yeah,
when live in New York. So
you don't live in New York?
They don't.
They don't.
Oh,
live in New
okay.
York.
All right.
Well, better yet.
All right, that's true. Well, thanks, Dave. I'm so sorry to hear about your wife, and have a great Thanksgiving.
Yeah, well, and God bless her that she's gone. She suffered, but in a way, she's lucky she went before she had to take a minimum distribution because that really would have screwed things up.
Yeah. Well, that's a bright way to look at it anyway.
So.
All right, well, you sound like a great dad. Thanks, Dave.
Enjoy listening to your show.
Thank you,
Very
sir.
Great.
Thank you, sir. Bye-bye. I'm Esther Gullius, the tax lady, 803-0930, 803-0930, star 930 on the cell phone. Okay, we're talking about the end is near. All right, we said put money into your pension plan, just like Dave says, or your IRA. Change your withholding at work to get more money for Christmas presents instead of taking it out of your 401k. Look at your portfolio. I think we had somebody yesterday. We had our friend from Georgia call,
right?
With his broker on the phone, and he didn't have any losers. But if you do have losers, this is the time you want to take them to offset those gainers because there's a lot of gainers this year. But the other thing is looking at your portfolio gives you the opportunity to make a plan, because you only have 45 days to make a plan,
Right.
if you can do a plan. So, and if you don't know how to read your portfolio, Chris, what can you come? Is there anybody that you know that can help them read their portfolio?
Us.
Yes.
We can.
Yep.
And we will help you, and there's no charge. So you can come on in and have a cup of coffee, and we'll explain what those figures mean.
Yep. Well, you know,
It's
we'll
always
try
good
to help
get a
solve,
fresh set of eyes.
yep,
Sorry.
solve the mystery and put the glasses on so you can see and understand. It's your money. You should be able to understand where it is and what it's doing. For
That's
you.
right.
And then I think also it's important is you were sitting with somebody yesterday and they said nobody's ever told me that before. So just another point of view is sometimes a
True,
good
true.
token.
All right, another thing you can do before the end of the year, if you are self-employed or you're somebody that's taking pension distributions, if it's not your RMD, you defer the income into 2015 if you want, if you're able to.
Right.
All right. In other words, if you don't need to do your billings, or you don't have to take that pension distribution, or you don't have to close on that piece of property or whatever sale you have, waiting till January will give another whole year and 3 months to pay the liability. So defer income. And then the other thing is, if you are 70 and a half, you got to take your required minimum distribution, which is really, really important, because if you don't, it's a 50% penalty.
Which is huge. And gosh, to make sure you take your RMD.
Right. And then the other thing you can do to reduce your tax liability is give gifts to charity.
Right.
This is a wonderful time of year. People are charitable. And they're thinking about giving gifts to charity. Make sure they're 501c3. They're churches, qualified not-for-profits, because not all not-for-profits are created equal. Right, Chris?
Right. There's some that are just, not for profit, but they're not the proper deductible kind. You got to be careful. Make sure you itemize. But I gave my $300 to charity. Isn't that going to save me? Well, if you don't itemize, it doesn't. But also, how about donating a car? People, we should start hearing those advertisements now, donating your car to charity, get that write-off. But that's not your immediate write-off, is when you donate it. It's when they sell it in an auction.
Unless they're using it for their own charity.
Right. So
true. If anybody wants a car to donate, they can donate it to our little guy that's from Florida.
Jake.
He hit a deer yesterday.
Welcome to Buffalo.
Oh, my gosh. And so he smashed his car up. And so sad.
Wait,
But anyway,
did he get a deer before my brother-in-law got a deer?
Yeah.
Oh, boy.
He did get a deer. He couldn't believe it, but there's no deers in Florida, not like that. Okay, another thing you can do, if you're between the ages of 25 and 65 and you aren't working, get a job.
Yep.
Get a job. You don't have to make a lot of money. You qualify for the earned income credit
Yep.
if you don't have other sources of income. So get a Christmas job. Get a job this holiday. If you make $3,000, they're going to give you an extra $1,000 from the earned income credit. I mean, holy
If
moly.
you're a single parent and you're not working, get a job, because your earned income credit can go up to $6,000 on the federal.
Yeah, there's a patient that I see, and her daughter has a disabled son, and I'm like, and I did their return. I go get a job, because she could claim the disabled son who's 25 who doesn't work as a dependent. If she got a job, she'd get the earned income
Right.
credit. Oh,
And I'm telling you, it's like free money. Again, it's free money. Then the other thing, use your cafeteria plans. You've been setting aside money in your cafeteria plan that's tax-deferred money and tax-free money if you use it. But if you don't use it, you lose it. So use your cafeteria money. Take a look. Go down to your HR department and see if you have any money in there, and decide to spend it. Buy items if you're a business person or you have rental property that are tax deductible to reduce your net profit.
Right.
So you take a look at your business and you say, gee, we could use some new computers. Gee, we could use a new printer. Wow. That's great, because it'll reduce your tax liability, and if you're self-employed, reduce your FICA. And same thing with rental property. Correct?
you got it.
And then get enrolled with the Obamacare. I will tell you, the Affordable Health Care Act is the law of the land, and I have my own feelings about it, but I'm going to tell you, if you're somebody that doesn't have health insurance, or you don't know about what the exchange will do for you, it sounds like it's this mythical
Ominous.
thing, but the truth is it's Blue Cross, Independent Health, what is it? Something Republic.
Health Republic.
Health Republic. I mean, it's the big insurance company. So when you go into the exchange, you get Blue Cross, you get Independent Health, you get
Health
the Health
Republic.
Republic.
Fidelis.
Fidelis. I mean, they're in there. So, and I'm going to tell you, if you're going to wait until you get penalized, it just doesn't make any sense. And some of you will get it for free, and the Medicaid rules are completely changed. So call us. We want to help you. There's no reason why you don't make that call to find out, to see if we can save you some money, right?
Tim, who works for us, he does a great job of navigating through all the cumbersomes of Obamacare, and he breaks it down. He's great.
Right. All right, I'm Esther Galias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Love to hear what you have to say. We're going to take a short break. We'll be right back.
E Street Band.
Wow, that's great. Out of 3 songs, we get 1.
Hey, if we played baseball, we could get paid $5 million a year.
The name of it is, hey, it's a lady's name. He said yes, it's a lady's name.
I don't know what it is.
I don't know.
ask me.
Tyler.
What is it?
Rosalita.
Rosalita. All right. I'm not Rosalita. I'm Esther Galias from EG Tax. 8030930. 8030930. Talk about stuff you should do before the end of the year. Okay. We talked about getting enrolled in Obamacare. And if you're somebody that is enrolled in the marketplace and you've got subsidies, we found out that the state of New York was computing those subsidies wrong, right, Chris?
Oh, they're mailing letters. They're canceling people's insurance, first of all, saying, oh, you qualify for Medicare, and mailing them a Medicaid card. Medicaid card right away when they don't qualify for Medicaid. So if you got one of those letters, give us a call. We'll help get it all straightened out, because you don't want all of a sudden something happen and you get rushed to the emergency room to find out you don't have health insurance.
That's for sure. And I'm going to... whenever the federal government governments are governments. But anyway, what you need to understand is just because they sent you the cards or just because they have you in this plan doesn't mean that when you do your tax return, you're home free. Because if the subsidy you got is too big, then you have to pay back the subsidy. So let's say that you or part of the subsidy anyway. Let's say, for instance, your subsidy was $3,000 to pay for your insurance, and when you really do your tax return, you should have only gotten a $1,000 subsidy. Guess who has a $2,000 tax bill?
Yep.
You do.
Right.
And so this is something you need to look at before the end of the year too. So we'll help you with that. Fit in to an exception to penalty. We talked. There's 22 exceptions to penalty.
That's right.
So, and one of them is
pretty broad. So.
They are pretty broad. And if you need help with that, go to our website. The exceptions to penalties are on there. Another thing, if you're looking for a big tax credit and you are looking for a new car, get the plug-in vehicle. The credit is up to $7,500.
You skipped refinancing your house too.
Oh, I did. Oh, yeah. And if your interest rate is over 4%, of course, this isn't going to help you save money in taxes, but it's going to help you over a financial situation. Refinance your house, and some of you might have a $80,000 mortgage at 7% or 8%. You know that you could do a home equity loan for 4% and pay it off and with no closing costs.
Yeah.
And that might be the way to go. And really, that's why you talk to an expert, to get all those little nuances that you might not know about.
Right. And over the life of the mortgage, you're going to save tons of money.
I'm telling you. And then, let's see, don't forget your estimated payments, especially to New York State, because it's an itemized deduction. And if you're in the middle of getting a divorce, call your attorney Monday and say, let's get this divorce done. Because it really does make it a lot cleaner at tax time.
Yeah.
And if you have children and you're going through the divorce, get the 8332 done in the court so it's not a fight come tax time, because divorce decrees do not mean anything come tax time for divorces after 2009.
And you know what I wanted to say? I had a client who called up the other day, and she is getting a divorce, and her husband has switched his withholdings so that he's not getting much withheld, and she kept her withholdings at it is the same. And so when they do the return jointly, she's going to get
paying for him, right?
She is.
Right.
And she said she can't afford to get a divorce, so she's in a pickle.
Anyway, I mean, these are things that are called tax planning, and I know it sounds boring, but we just want to help you so that you don't overpay, and you got friends here.
Yep. And I was going to say, like us on Facebook. We put these tips up there. Every week we add a new tip.
Yep.
You get to hear our radio shows through Facebook. We give you any news that comes out right away. We put it out there.
And during the week, we have all kinds of people that are that like us in person. Just come on down. You can make an appointment. Don't make an appointment. Our corporate office is open 9 to 5 Monday through Friday. And we want to help you until tax time when we're open all the time. Let's go back to the phones. We'll talk to Larry in Lockport. Hi, Larry. How can we help you?
Hi, good afternoon. How you doing?
Great.
Hey, I have a question. Actually, I had two questions I told the fellow at the beginning there.
Yeah.
One of them has to do with, I have school loans that I'm paying, and they're actually in my wife's name because we consolidated.
Okay.
And we were suggested that we file taxes this year separately.
That's
married
true.
Filing separately.
Mm-hmm.
We've been filing jointly,
Mm-hmm.
but my income has changed drastically. I had to retire due to a medical reason, and so my wife works part-time, and she also gets Social Security, and I get Social Security. So
Okay.
we get along fairly well, but I'm just wondering about the changing of the tax. the way
Okay.
we do tax.
See, they and Tiffany, you probably can speak to this real well. They base the payment on your if you're basing it on income on the household income, then the joint income.
Right.
So sometimes it's better. So it's not like taxes are complicated enough. Now you have to factor your student loan repayments in there.
Right.
Sometimes it's better to file separately because separately, let's say her income is substantially less than your income. But it sounds to me like your income went down. So maybe what you need to do, I think you can call Nelnet and say to them, how much is our payment going to be if we do it this way, and how much will our payment be if we do it
and
this
if you
way?
do married filing separate, you can't take the student loan adjustment to income, so that's
Right, and
a
so
problem.
so what happens is you may save money on your Nelnet payment, but it may cost you tax dollars. You have no children at home anymore, do you, Larry?
They're off road.
But
Okay.
but if you talk to Nelnet, like Esther said, they're going to give you options. There's like a 10-year plan. There's an income-based average plan. So the best thing to do is to call Nelnet, and there's different plans depending on where you are in your life.
And again, if you don't want to do it on your own because maybe you're thinking, I don't know how to talk to these people, come on
I've been
into.
dealing with them for several years.
Oh.
I went back to school when I was 50.
Oh, great. All right. Well, then tell them, say, here's our tax return last year, but now I'm making $30,000 less, and how much will our payment go down if we continue to file jointly if our income has dropped $30,000, and how much would it be if it's just in my wife's name?
And you said you're disabled now?
No, I had to retire because I had a mental health issue.
Okay. Now, how old are you, Larry?
Well, I tell everybody 39.
Me too.
Hey, my dad's age 30.
I'm actually 68 if you go by the calendar.
Okay. All right. Good enough. Had you been under the age of 65, then there was a possibility that, and your income was low enough, you'd want to reclassify that from a Code 3 to disability, so it'd be wages to qualify for the Earned Income Credit. But in your situation, that won't make any difference. But I would call Nelnet and say, this is my income jointly. This is my wife's income. She's the purveyor of the loans. How much will the payment go down if we do it income-based?
Okay. We had actually got into one of those deals where this company promised to set us up for the income-based payment plan.
Yep.
They charged us like $800 to do this, which we fell for. So I called them up, worked through with them, and they offered to give me half of my money back.
Well, isn't that nice of them?
Yeah. I told them they didn't do me any good because when I did talk to Nelnet, who was our...
They would have just helped you over the phone for free.
Yeah, that's what he said.
And so that's the whole thing. what you don't know can really hurt you. And so when somebody calls you and they say they're going to help you and there's there's money attached to it, call EG Tax and say, gee, should I be paying that? Because we will tell you the truth. And, okay, did you have a second question, Larry, quickly?
Yeah, real quick. Filing, if our income is basically just Social Security, is that taxable?
Well, if you guys live together, right?
Yep.
So then 85% of your Social Security would become taxable right away because you live together.
Now, does your wife have income,
right,
Larry?
Right, that was my next question.
She works part-time. She was per diem. Now she went back part-time so we could pay
What do you think her wages are?
Oh, I would say $400 every couple of weeks, maybe.
Okay, so about $800 a month, about $9,600 a year, right?
Yeah, something like that.
And then she's not on Social Security, though, right?
You got Social Security when she was 65.
All right, so she's on Social Security, too. All right, so what will happen if you're living together is your Social Security is going to be 85% taxable for both of you, and that's got to be factored into the Nelnet thing. What you might want to do, Larry, is give them a call. Give us a call first. Let us tell you what the tax liability is going to be if you're married separate, married joint, so you know what it's going to cost you in income taxes, and then call Nelnet so that when you see how much the payment's going to drop or go up, you can factor that in.
Yeah, you guys did our tax last year.
Oh, well, then you can call. We have all your information right there.
Yeah, you do.
And I'll actually run the numbers.
We'll run the
ways.
numbers. That way you can talk intelligently. And Tiffany is like the queen of three-way conversations.
Yeah.
So she can plug you right into Nelnet. You can talk directly to them, and she can aid you in the back end. Okay?
Yeah. Well, we go through the one in Lockport on Transit Road there.
We got it all at our corporate headquarters.
Okay.
All right, Lair?
All right. Well, thank you very much.
Thank you.
God bless you.
Happy Thanksgiving. You
And
too.
you as
God
well.
bless you. I'm Esther Gullius, the tax lady from EG Tax. We got a couple minutes left. Just want to remind you, our upcoming seminar is December the
3rd at Holiday
Inn. And if you would call us or email us to let everybody know, we're going to have Dennis Kitchen there who's going to help you with estate planning,
insurance.
and we have Bill Barber, the insurance guy, is going to show you how to save money on your insurance.
We're going to talk about S-Corps, C-Corps.
S-Corps, C-Corps. We're going to have
our healthcare
care specialist there. So if you're wondering about how to get signed up for Obamacare Marketplace, even if you hate it, which I'm no great fan of, I will tell you. But the thing is, it's there. And if you can get a benefit, then you deserve the benefit. And you should, as long as the game plan is like this, play by the rules of the game. And if you can make it better for yourself, make it better for yourself. And, of course, and during the week, if you get love letters, you haven't filed. Somebody called me yesterday, has said he hasn't done a fiduciary return in 10 years. We're doing that. I mean, that's what we do, and we want to help you. So during the week, give us a call at 632-7886. That's our corporate phone number. Our web address is egtax.com. And until next Saturday, I'm Esther Gullius, the tax lady, with Tiffany Fabian, Christopher Fabian, and Gracie. And we'll talk to you during the week. Bye-bye. Have a great week.